Hey, welcome back to Two Super Guys Try Socks. I'm Dylan.
And I'm Vinny, and holy crap, we're finally seeing yield on inversion after the longest period of interest rate yield inversion in history. We're going to talk about what it means, and we'll talk about what it can imply for the U.S. economy. All right.
Hmm.
So, this is a lovely chart I pulled from one article. This is actually accurate. So you're displaying it now, where we're seeing we're going to get to the actual chart itself here in a minute, but basically the relationship between yield inversion and recessions, those gray shaded areas. All right,
So, I have a quick question. Didn't
shoot.
we hit this earlier? Is it just we didn't close? Is that the thing?
Yeah, so we were teasing it all of like August, basically. Like that
Okay.
thing that you enjoy doing. What do you call it again? Edging.
Edging.
That's the
It's
one.
edging.
Yeah. So we're finally now closing in positive territory here on the federal like actual database, right? So this is from the Federal Reserve of the United States, and you're seeing it now here as a positive number. All right, 0.06. This is the 10-year and 2-year Treasury inversion. Right?
Got it.
Those are particularly the ones that people tend to watch. There's a couple other, but like this is like the big dog, if you will. And why does this matter, right? So this is just a general kind of representation of the cone of uncertainty. In
The
general, as you
cone.
project things out further into the future, things get more like less and less predictable, right?
This has the coolest name. The cone of
Yeah,
uncertainty. Okay,
yeah.
I'm interested. Let's go.
It's actually a nickname for someone's rectum too. It's an entirely different category of jokes here. The idea behind
Jesus
this is that
Christ.
an investor should be paid more when there's less kind of certainty in terms of future performance of an investment. So that's why it tends to be, or would logically dictate, that longer dated, instruments such as just 10-year bonds should have a higher premium than shorter dated ones. But we've been living in la la land where that's been inverted for the last like 2 years effectively. Right? But we're now snapping back out of that and going back to reality, like that song, right? Um,
Hmm.
so a few articles I pulled some snippets from here, but out of the last 6 recessions in the U.S. faced since 1980, 5 were preceded by a yield inversion of at least 20 days. All right, this one's well past 20 days. There's the actual record is in here. Yeah, 793 days.
So we slightly beat
Ridiculous.
it. Okay,
Yeah,
got it.
we made that 20-day threshold just a little bit, and then the sixth one, all right, actually resulted from the COVID pandemic, and there was an inversion, but it was shorter. Right, it was only 6 days instead
Yeah,
of requisite
that
20.
recession or whatever that was throws off so many of these statistics because it was such a unique scenario because it had nothing
Yeah.
to do with macroeconomics and it just the world shut down. So it was
Mhm.
really weird.
Well, one of the challenges with any sort of applying this to prior recessions is that this is a very unique one, following another very unique episode. But we don't get a lot of data points, right? You're talking about 6 recessions since 1980, right?
Yeah.
That's majority of like an investment lifestyle is 45 years. And we're looking at just 6 events during that time period. It's not a very good data set. Um, but this time the yield curve had been inverted for 793 days, or about 26 months, and still hasn't been a recession. Right? Typically, a recession occurs between 6 and 24 months after the 2 and 10 yield inversion. All right. Now, 6 and 24 months is kind of a useless time horizon
Yeah.
too, right? Because it's like you could always be within 6 and 24 months of almost anything.
Yeah.
It's like, oh
That
yeah,
is
it's gonna
a
gonna happen.
Harvey Harry Dent statistic. That's okay.
Yeah.
So at some
Yeah.
point in the future we'll have a recession. Cool.
Cool. Someday. Um, a chart mapping the yields of the debt has inverted, and it is tempting to say things have malfunctioned in the bond world, and that we should just give the U.S. economy a clean bill of health when yields on the 10-year debt finally end a trading day above those of the 2-year notes. But it's too soon to stop worrying. All right. That's
Okay.
kind of like the main point here as far as like the timing goes. Even if the yield curve normalizes once and for all, it doesn't mean the economy won't stumble. Right. So we're normalizing now, but we may be looking at economic uncertainty. I got a couple data points on that towards the end too. History has shown that the problems begin when prolonged periods of inversion end. All right. So it's at the end of these time periods is when the shit hits the fan, so to speak. Right. I'm
Got it.
looking up at my ceiling fan as I say that. um, The four most recent recessions, 1990, 2001, 2007, 2020, started only after the curve turned positive, which is what has happened now. In each case, a downturn started between 3 and 6 months after the curve turned positive. Jeez, reading public reading.
So this would be a good kind of segue. We did another video when I was looking at the labor market, and we took a tally of a bunch of comments, and it seemed
Mhm.
like no one was saying the market would be negative within the next year. That there would not be a recession soon, within 6 to 12 months. So we're in the minority here, but it's just
Sure.
okay. All right.
Yeah, it's funny too. Like, this is a chart that will kind of represent exactly what Dylan's talking about, but from like a corporate governance standpoint. Um, the uninversion is being driven by what experts call a bull steepening in treasuries. All right, so it's a bullish rally in the price of treasuries across the board, but you're seeing a more aggressive rally in the 10-year than you are in the 2-year. All right. Um, those on the short end have fallen faster. This often happens when investors are optimistic about future economic growth. In other words, it could signal a perfect soft landing as well. So that's another counterpoint to this. Maybe they're just really happy about how good Jerome Powell has done as far as the job.
I do think he has done a good job.
He does. So this right here is actually that chart that was in the background of the title slide. This is a great one where it's showing the yield on inversion and then the recession timing period here. All right, this is the amount of time between the two as well. So that gives you an idea of what sort of range we're talking about here. Remember that 3 months to 6 months. So we're looking at the shortest one is this 84 days. The longest one is 287 days. So it's less than a year, all right, before you hit that recession time period during all of these episodes. Of course, the 2021 didn't quite qualify in the traditional rule of 20 days of inversion or more. It was only 6 days, but if you give it credit for, this is the kind of time horizons you're looking for.
Okay.
Yeah, and this is the performance during those time periods for the S&P 500, right? So actually, three of them are positive, which is impressive.
That is weird. That one's throwing me a little bit. So during the recession, the S&P 500, is it from the start of the recession to the end of the recession, the gray, that it was positive?
That's a good question. I don't know. I don't
Okay,
know.
because that's
That's a
weird.
good, really important to know, and I don't know it because I'm an idiot. But
Yes,
yeah,
because
makes
it
good
could
sense.
be like a 12-month for the year, and if because
Yeah,
I've shown that graph multiple times. Usually during these recessions, the first 3 months of the 12 are you lose everything, so it's a huge drop, and then if you go 12 months from the start, you could be positive.
yeah, exactly. That was like basically last week's point. This is another one I wanted to highlight here. This is a chart looking at the number of mentions of the word recession on earnings calls. Yeah, you see where we are.
Okay.
Just as you were saying, not only are people in our YouTube comments saying that it's not possible, that the actual CEOs on these earnings calls are also saying like, "What recession? What recession? Like we have no idea what you're talking about."
Yeah, and we don't know anything. I will,
Yeah.
and that's not a sarcastic thing. We don't know what we're doing. So that would
Well,
seem like okay, maybe not.
how can you have recession when they're revising GDP data up and you're getting now 3% on an annual basis where at U.S. economy generally 2% is kind of what we hope for. So you're getting upward revision and big sexy numbers like 3%.
So
Can't even
three
think of that.
percent, very very solid. September 26th is going to be very important because if that one is lower, then the one after that, if it is lower than whatever September is, that would be the two GDPs. This is weird because when you look at the definition of a recession, they're always like just two negative GDP quarters, but you also have to have the labor market coincide with that. It's not as black and white as that. There's a lot
Yeah.
of different factors. You can't have two negative GDP quarters and like record low unemployment and everyone making more money. It doesn't.
Yeah.
Yeah.
There's a U.S. government department that actually has to officially declare the recession, and they can do it significantly after the recession.
Yeah.
It's very
That's
common for
true.
them to be declaring this recession started 6 months ago. Like we don't even know. We've been living in like this la la land. It's like kind of a little sixth sense. Bruce Willis when he figures out he's actually a ghost. It's that sort
Spoilers,
of
dude.
scenario.
Come on.
Yeah, totally.
It's only been out 30 years.
Oh, the other interesting kind of data point we got this week was unemployment, right? You saw a slight tick down in the unemployment rate, down to like what was 4.3 to 4.2%, I think
Mm-hmm.
was the
Yes.
headline number. The number of jobs created is still on like overall downward trend, but better than expected. Yeah,
It was better. So that was what I was most nervous about because
yeah,
generally The next couple of months can be very, very important. As employment starts to shoot up, it usually shoots up quite quickly. So that was
Yeah.
nice to see.
And this is the way Powell prefers to look at unemployment data. He looks at available number of jobs per available worker. And if you saw down here for quite a while, we were down to this like 0.5, meaning that there was two jobs available for each
Yeah,
worker that was in the market. We're coming back into balance here. Where we're approaching this one level, meaning that there'd be approximately one job available for every worker that's looking for work. So,
perfect.
much more balanced job market. And the other thing he looks at too is quits. Number of people just saying, you know what, screw it, I'm out of here. Like, I'm gonna go find another better job. Quits have come down significantly. Are kind of back towards like this pre-pandemic level.
Okay.
We're approximately there. So the job market has definitely come back into balance, but we haven't seen any significant disruption from what would be like a normal job market or pre-pandemic job market. So he hasn't seen any sign that he has to be really aggressive. We're looking at the Federal Reserve meeting coming up here, and this 50 basis points probably not going to happen. I think it's going to be 25. This is what I wanted to close on here, though. All right. So
Yep.
Dylan and I love talking about this major macroeconomic data and like all these crazy trends going on and like worrying things and positive things. But when it comes to where I put my money, I am still continuing dollar cost average into like index funds outside of the money that I actively play with. But that's where I contribute because of this chart right here. You shouldn't start trying to time things based upon these macroeconomic events. They're fun to listen to and fun to kind of try to figure out and predict the future. But if you start making your actions based upon those guesses, those estimations, you can really shoot yourself in the foot here, and your returns will really fall off rather dramatically if you just miss a certain number of really good days, just
Yeah.
days. All right.
So
So
I
ride it.
agree for the most part. However, so for instance, I'm not I'm not going to sell any of my holdings. So like for instance, if there isn't one, I'm fine. It's not a big deal. I have a certain percentage collecting interest on cash. I have a certain percentage in TLT and a certain percentage in stocks. I feel like this chart is more for the people who are like, all right, I'm going to sell everything right now and then buy when it's low. That's a bad
Mm-hmm.
idea. We never know when it's going to happen. The next 2 years seems impossible to me. Could be the best 2 years of the market ever, and
Yeah.
I'll be fine because I have all my holdings. But what I do, and what I have done in the past, is I'll take like a small amount, like 1 to 2% of my portfolio, and do like a short option or something, right? And then if I'm wrong, okay, I lost 1 to 2%. The stock market went up. I got those gains. Still positive, but just not as positive as I could be. If I'm
Mm-hmm.
right, it's just a little. Usually, when you're right on those, you're really right.
Yeah.
It just
Insurance.
you just it's a little bit of an insurance policy. So, for instance, I'm a strong believer right now in TLT. When rates were super super low and TLT was very very high, it's kind of common sense, has to come down. So I took a certain percentage, made money, and then I put it into stocks. So it's super risky to just put all your money like what is it, Wall Street bet style, and just be like, oh yeah, Q
Yeah.
puts like
Yeah.
do may
Absolutely.
like one, depending on how much money you have, but don't risk a lot here. That is
Yeah.
not worth it because you can. I mean, the stats will show you will be wrong the vast majority of the time.
Exactly. Yeah, yeah. So try not to time the market. You have to just kind of ride the wave and figure out that over your working career that you will return approximately like that 11% on average, pre-inflation adjusted dollars that S&P 500 classically returns, and just kind of ride it out. You have to ride through these cycles, whether or not you think the economic data is looking softening, and particularly in a time right now where it's very, very murky and uncertain as to what the data is really telling us.
Yeah. You can time companies. Like you can time Nikola short like any time the last 3 years and made
Yeah.
money. Like it's not
Eh,
like but that's not the
Yeah.
market. That's like one
Yeah.
shitty company. And there's gonna
Yeah.
be more and more shitty companies and possibilities to do that. Like that was free money for a long time. So that's the caveat.
Yeah. The right time to short Nikola is when the market is open.
Yeah, there you go. Yeah. They're actually
All right, guys.
they're so low, it's scary. All right, guys. See you
Catch you
later.
the next one. Yep.